And Michael Rourke is chief market strategist at JonesTrading with more on the market story. Mike, nice to see you. How would you characterize what you've been seeing starting with August, where we have been taking it feels like a bit of a breather or a little bit more choppy action?
Yeah, it's definitely been a little more quiet. Obviously, lots of people on vacation. And I think there's uncertainty about where Fed policy is going. Everyone knows we're at the end of the tightening cycle, whether or not they'll tighten next month. But we're seeing that deceleration in the jobs data here in the United States. But we also see wages stronger than expected. So it doesn't look like we're out of the woods on inflation yet. And again, you mentioned this morning. That rise in energy prices and oil, that's significant because as we head into over the next couple of months, the big benefit CPI inflation and PCE inflation received at the headline level from declining energy prices is going to start to get smaller and smaller. So I think inflation's a little stickier than people expect.
And so how is that positioning ultimately where you would suggest being in the market right now?
So, I would be cautious on this tape. That's not a surprise. It's a view I've had for some time. Most of the gains this year have been driven by a handful of names. And if you're not in those names, it's been a much tougher tape. And to the point where the leadership's been so narrow among those names, that's pushed valuations down or made other groups more attractive. Obviously, the risk going forward here is after having 15 years of basically zero or near zero interest rate policy, we're going into an environment where we actually have, a Fed funds rate above 5% now. It will be at that level or above going into next year. And I know the Fed has talked about bringing interest rates down, the Fed funds rate down as inflation decelerates, but we still haven't had that meaningful inflation deceleration that's needed. When it comes to core PCE, June was the only really drop we saw all year. The balance of the year, core PCE was about 4.6%. And like I said, it looks like it's a little more challenging going forward than people realize.
So you're cautious on tech. You're keeping a close tab, though, on financials, which you've been eyeing for some time. In this higher interest rate environment, what do you think about some of the real estate-related plays, real estate investment trusts, for example?
So, and that's where it gets interesting here, because we are close to that inflection point on the Fed funds rate or the Fed pausing, at least for now, or the end of the tightening moves, and that gets interesting. Whether it's certain interest rate sensitive names that have not run away. For example, REITs, I think, would become attractive here once the tightening is done. Even utilities, which have had some pressure due to rising rates, there'll be more attractive names in that space because the tightening's done. On the flip side, as far as interest rate sensitive as names, you have home builders. There's been such a short supply of homes in the United States that they've had an incredible run despite the rising interest rate environment. So I don't see them getting the benefit of the Fed pausing at this point. So I think you have to be very careful as how you approach the market going to, in the second half of the year.
We mentioned that oil is rallying today. Certainly some of the fresh geopolitical jitters playing out in the Black Sea could be one of the considerations for crude. But the fact that we're back above $83 U.S. barrel, what do you make of that, Mike?
Yeah, like I said, that's going to be a problem going forward for headline inflation numbers that people seem to have gotten very excited about in the past couple of months. The big move higher last year with Russia's invasion of Ukraine, led to a peak, I think it was in June and July, in crude prices. And then obviously we saw the biggest benefit we were going to see last month in the inflation data as far as headline inflation. So while oil is still down year over year and still will be a negative driver of headline inflation, it will do so at a much lower rate. So basically, I think last month it took about 1 percentage point off of headline inflation, or more than 1 percentage point. So again, that's just that's a headwind going forward, that these numbers aren't going to drop as quickly because you don't have that volatility tied to Russia's invasion of Ukraine.